wanna take you everywhere I've been to, through all the corners where I thought I'd meet you.
2020 is shaping up to be a record year for betting on stock options. On an average day, traders drew up more than 26 million such contracts, a huge rise from the year before.
9 out of 10 of the busiest days in the options market's entire history, going back to 1973, have happened this year in 2020.
Option contracts give traders a way to make a buck by betting on which way the markets will swing, which makes them especially attractive when markets are choppy like they've been this year. But there's a catch. Options are a risky investment, sometimes even riskier than stocks. And as more beginners try their hand at trading, experts warn of big losses. At its most basic level, an option is a contractual agreement between two parties regarding a particular asset, say a stock. And there are two basic types, calls and puts. With a call option, the buyer gets the right to purchase shares at an agreed-upon price and date. If the trader doesn't buy the shares in that window, she loses the right to buy the shares at that price.
And that's an important feature of these options contracts. You don't have to exercise them. You simply have the option to do so within a specific time frame.
When a trader buys calls, they're typically making a bet that the asset will rise in value. If it does, she can profit. Let's walk through an example. Shares of a company are trading at $100 on the day the option contract is bought. A trader secures the option to purchase 100 shares at $120 each at some point for the next month. In this scenario, $120 is the strike price. The trader that buys the contract thinks the stock will rise, so she pays a premium of $3 per share, or for this contract, $300 total.
Many investors are using these options contracts as trading tools, and often they don't even have an intention to exercise them. For example, if you buy an option and the contract itself rises in value, you might sell that option contract in the secondary market.
In this case, the call holder is using the option contract as a trading tool, not dealing with the underlying shares. But this type of trading can get complicated.
Sometimes it's not as simple, and that's because there's a lot of different inputs to options pricing. That includes the strike price that you're buying the option for, the time to expiration, and also the implied volatility, or how much the stock is expected to swing up or down in the future.
The option buyer has other ways to profit as well. If the share value rises higher than the strike price and the premium paid, the buyer can exercise the contract. In this example, say the share price rises to $135, which is above the strike price and premium combined. The call holder can buy the stocks for $120 and sell it on the market for $135, pocketing the difference. But let's say the shares price never rises above $123. In this case, the contract holder doesn't have to buy the stock. She can toss the contract in the trash and walk away, having only lost the premium of $3 per share. But this is where it gets risky for amateurs. These losses can add up quickly.
Options can seem like a relatively cheaper way to sometimes bet on expensive stocks, but if your hunch is wrong a few times, that can be several $100s at a time, just kind of going down the drain and potentially burning a hole in your portfolio. You may think, I just need to put down $200 or $300 for this options premium, and if the stock does this, I'll be right and I can make a quick 40% return. But if you're wrong a few times, that's a lot of money for a lot of people.
And this happens frequently. Many options go unexercised. Now, the other kind of options trade is a put. In a put contract, a trader who owns a stock is buying the right to sell that asset to someone else for a particular price by a particular date. A trader might buy a put if they think the stock will fall, or if they want to hedge their holdings. Similar to a call option, the trader has the choice to sell or walk away from the deal and lose the premium.
People often use put options to bet on stock declines or hedge their portfolios, kind of like a stock insurance. So a portfolio manager could use a put option to, protect a portfolio from bigger declines in the S&P 500 or something like that.
So those are the fundamentals. Now, here's why options are popular. Investors like options partly because the premium can let an investor control more assets than they otherwise could afford.
They can be kind of a cheaper way to bet on, somewhat expensive stocks. For example, Amazon, has been recently trading around $3,100 a share. Meanwhile, you could buy an option contract tied to Amazon, which technically gives you control over 100 shares of Amazon for a few $100s.
Another reason why options are popular this year: big swings give investors more chances to bet. The pandemic and election have led to huge fluctuations in stock prices, which has given traders more opportunities to bet using option contracts. Another reason: people at home have more time on their hands and are trading frequently. Recently, small trades of a single contract made up 8.7% of all options activity, according to Trade Alert data. Those traders are taking a risk because making the right call, or put, is difficult, if not impossible, even for the most advanced traders. Not to mention the fees and capital gains taxes, which can eat into your profits.
It can be really tempting to make these short-term, relatively cheap bets on where individual stocks or the market will go. But it's really hard to figure out what the stock market is going to do next. And if you guess a few times wrong, you could be out a lot of money.
For a smaller investor, that means that consistent success trading options is tricky. Regardless, traders are free to swim in the choppy waters if they wish.
陪我春秋冬夏，羽化我的伤。